Think Warren Buffett is untouchable when it comes to investing wisdom. Think again. Today, we'll dive into why Ben Felix is taking a stand against the Oracle of Omaha's ideas and why active investing might be costing you more than you think. Start with upbeat music and an animated infographic of Warren Buffett with dollar bills raining around him. Active investing, the golden goose for Wall Street or a costly trap for everyday investors. Warren Buffett has long been hailed as the champion of value investing, but there's a bold voice in the financial world challenging his legacy, Ben Felix. Today, we'll uncover why Felix believes active investing might not be the golden ticket it's claimed to be. Introduction to Ben Felix and active investing. Cut to a clip of Ben Felix speaking if allowed or a stock image of a thoughtful investor. Ben Felix, a financial advisor and YouTube creator, is making waves by questioning the very foundation of active investing. He argues that active fund managers, despite their claims of beating the market, often fail to justify their high fees. But here's the kicker: even Buffett, with his legendary track record, isn't safe from Felix's scrutiny. Breaking down Buffett's approach. Show visuals of Buffett in shareholder meetings and news headlines about his investments. Buffett famously advocates for low-cost index funds, and for good reason. Yet, paradoxically, he's made his fortune by picking stocks. Felix points out this contradiction, suggesting that while Buffett's methods may have worked decades ago, they're far from replicable in today's highly efficient markets. Why? Because markets have evolved, and so should we. The case against active investing. Transition to an animated graph showing high fees eating into investment returns. Active investing comes with a hefty price tag. On average, active funds charge significantly higher fees than passive index funds. And here's the brutal truth: studies consistently show that most active managers underperform the market over the long term. Felix drives this point home with data-backed evidence that choosing a market-matching index fund could save you thousands in fees while delivering better returns. Why most investors should choose index funds. Cut to an animated comparison between an active fund and an index fund over 20 years. Felix's philosophy aligns with what modern research tells us. The average investor isn't Warren Buffett. For the majority, it's nearly impossible to outguess the market. Index funds offer broad diversification, lower costs, and the peace of mind that you're not gambling your hard-earned money on unpredictable outcomes. Key takeaways and Felix's final argument end with an image of Felix's book or YouTube channel if applicable, and a strong call to action. So, is Buffett wrong, or is Felix onto something bigger? While Buffett's legacy will always shine, Felix offers a stark reminder that what worked for one man in a bygone era might not work for you today. Stick to the data, and remember, slow and steady often wins the race when it comes to your investments. If you found this breakdown insightful, hit that like button and subscribe for more financial wisdom. Share your thoughts in the comments. Do you side with Buffett or Felix? Let's talk about it.